Welcome to the IFRS for SMEs technical series. I am Calverwell and I help SMEs apply accounting standards to improve reporting, strengthen compliance, and build credibility with banks, investors, and partners. In this video, part of the Technical Accounting for SMEs series, we are looking at Section 21, Provisions and Contingencies. We'll cover what provisions are, when they are recognized, how they are measured, and the disclosure rules for contingent liabilities and assets. A provision is a liability of uncertain timing or amount. A liability is a present obligation arising from past events where settlement is expected to result in an outflow of resources embodying economic benefit. This section excludes provisions covered elsewhere, such as leases in Section 20, construction contracts in Section 23, employee benefits in Section 28, and income tax in Section 29. Executory contracts, where neither party has performed nor both parties have equally performed, are outside of this section unless the contract is onerous. An entity recognizes a provision only when it has a present obligation at reporting date from a past event, legal or constructive. It is probable, more likely than not, that settlement will require an outflow, and the obligation can be reliably estimated. If these are not all met, a provision cannot be recognized. In the financial statements, provisions appear as expenses in profit or loss unless they form part of another asset's cost, like PPE or inventory. On the balance sheet, provisions are recognized as liabilities. No provision is recognized for obligations that arise only from future actions. For example, an entity planning to install smoke filters in a factory has no present obligation until it actually commits. Future intentions do not create provisions. Provisions are measured at the best estimate of the amount required to settle at the reporting date. For large populations, use probability-weighted outcomes. For single obligations, use the most likely outcome adjusted if the other outcomes are significantly higher or lower. When time value of money is material, use present value of expected outcomes discounted using pre-tax rates reflecting market conditions and liability risks. Provisions are measured before tax. Tax effects are dealt with under Section 29. Provisions exclude expected gains on assets disposal and uncertain reimbursements unless virtually certain. Where reimbursement is virtually certain, recognize it as a separate asset. Recognize it as a separate asset, but do not offset against the provision. In the income statement, you may offset reimbursement income against the related provision expense. Provisions must be reviewed at each reporting date and adjusted to reflect current best estimates. If discounted, the unwinding of the discount is recognized as a finance cost. Settlement is charged only against the original provision. Differences between estimated and actual settlement are not treated as errors. Contingent liabilities are either possible obligations depending on uncertain future events or present obligations failing recognition criteria. They are not recognized, only disclosed unless outflow is remote. Contingent assets are possible assets dependent on uncertain future events. They are also not recognized, but disclosed when inflow is probable. Section 21 helps SMEs handle uncertainty in accounting. It ensures provisions are recognized only when justified, measured reliably, and backed up by full disclosure of contingent risks and opportunities. Stay tuned for the next part of the Technical Accounting for SMEs series, where we'll cover another key area focusing on share-based payments.